Hello everyone, Luke Kurey here, registered investment advisor extraordinaire. This is the first ever video for myself as an investment advisor and for my firm, Pulse LLC. It's just something fun to mix it up a little bit. Instead of always writing, I thought I should make a video. So I wanted to make a video of what's been happening at Pulse over this last year, and there's lots of fun and profitable stuff going on here at Pulse. We've implemented a lot of new strategies, and some of them have stuck, some of them are gone. I want to talk about some of those strategies, some of the processes, some of the good trades and the bad trades that have gone on in client accounts throughout the year. But today I became distracted, and that video is going to have to wait for a bit, maybe a few days. And for now, I'd like to share the results of what I got distracted with. I was looking at an anomaly in the stock market, well, possibly an anomaly, and I did a little research to figure out if it was in fact an anomaly. I was wondering, with the end of the year coming up here, I was wondering what U.S. large cap stocks tend to do around the end of the year. I operate a lot of statistical and systematic strategies, so this idea goes along with how I like to pursue returns for clients. First thing we're going to do is look at this here Excel sheet that I made. I have all the data for all the years here, and then I kind of did this and that with some formulas and math and came up with these charts here. The first thing we're going to look at is all 130 years and the 10-day period from December 27th to January 6th. On average, that's 10 trading days. And what we found is that there's a 1.3% median return over this 10 trading day period. Not super exciting, but when you annualize that, that's over a 30% gain without dividends. That's over a 30% just price move gain if you could annualize that. Whereas over the 130-year period, the Dow only appreciated without dividends 5% annually. So no doubt this 10-day period is an anomaly with over 30% annualized gains for that period. So the next thing we're going to look at is whether or not this gain occurs more on one side of the new year or the other, and it turns out that it does not. The median return for the last days of December is 0.51%. The median return for the first few days of January is 0.5%, almost the same. Nothing real interesting there. So then I thought I should look at, hey, what about bull years? What about years where at the end of December we are at a higher point for the Dow Jones than we were at the beginning of the year in January? So we broke that data out, and turns out there are 83 bull years as I define them. 83 bull years in the last 130 total years. That's 64% of the time. And the anomaly is actually less strong during these bull years. The 10-day end of year period returns on average, or median, 0.72% for bull years compared to 1.3% for all years. And more interesting than that to me is that the last days of January are actually pretty good, 0.51% median return, but the first few days of January are not good at all, well below the market average there, or well below the all days average, with only a 0.01% almost flat gain. And I was wondering why that was, and my plausible explanation is that At the end of a bull year like this year, everyone has made money in pretty much all their stocks. People generally have few or no losers for the year. People and institutions, all traders generally don't have a lot of losers after the end of a big bull year. So nobody is selling late in December. People might be buying late in December, but people are generally going to wait until early January to do any selling, so that any gains that they realize through that selling don't need to be recognized and paid until April of the next year, 16 months later. So that's my explanation. And if this explanation has any merit, then we should see the opposite behavior at the end of bear years. Turns out that's exactly what we see. The last few days of December in a bear year are okay, 0.54% median return, that's pretty good. Or the first 5 days of a new year after a bear year are quite anomalous, with a 1.08% median return. So at the end of December, after a bear year, you probably have a lot of losing positions. So people are selling their losers at the end of December, harvesting any tax losses. A few days later, these positions are replaced with similar positions. Everybody that was a seller in late December becomes a buyer in early January. That's going to be typical behavior at the end of a bear year. That fits this data quite nicely, and this is hugely anomalous. January 2nd to January 6th after a bear year, the median is 1.08%. That's over a 50% annualized gain. Talk about anomalous. Apply some leverage on those days, because that's remarkable. Or don't. It's up to you. You're going to have to store that away, because this has been a bear year or a bull year, so you're going to have to store that info away for a while anyways. So what is the point, Luke? This is a pretty lousy hot tip. I would say it's a pretty lousy hot tip. Just tell us the trade. There is no trade. This is just a tailwind that we should pay attention to as we consider doing other trades. But let's say we're considering shorting Caterpillar. Let's just say that. We know the components of the Dow tend to do quite well around the end of the year. That's what our research, our analysis just told us. So if we're going to be shorting Caterpillar at the end of the year, the Dow doing quite well is going to be a headwind. We need to be very confident in our trade. Then the opposite of that is also true. Say we're trying to get super bullish on tech stocks and we're going to use some options for leverage. The end of the year would actually be a better than average time to do that, since we have this statistical tailwind that we just discovered. That's that. We'll see you next time. And, of course, Merry Christmas. Go for a run, eat a cookie, hug your family, roast a ham, whatever. Listen to some Bublé. Be well. Sincerely, thank you for watching, and Merry Christmas, everyone.